All right. So our first paper is the Taming of the Skew, Asymmetric Inflation Risk and Monetary Policy. Andrea de Polis will present it from ESCOE. So, Andrea, the floor is yours.
All right. All right. So thank you very much for including this paper in this great program. So today I'm going to talk about asymmetric inflation risk and monetary policy, and this is a joint work with Leonardo Melosi and Ivan Petrella. Well, I guess the last few years are a little bit interesting from this perspective because we've seen quite significant events that have, to the least, amplified macroeconomic risks, but especially have brought about a significant shift in the balance of macroeconomic risks. So to give you an idea, we went from a pre-pandemic period where macroeconomic risks, more or less globally, were somehow subdued or contained, and inflation surprised on the downside quite often, to a post-pandemic period where basically the likelihood of downturns and perhaps inflation spikes seems to be more likely. However, in the literature seems to be a little bit scarce in terms of how changes to the balance of macroeconomic risk should affect the economy in general equilibrium settings. And thinking about it, I mean, this sort of makes sense because perhaps there is not so many events that one can use to model. And also, probably these are highly nonlinear events, which would require some sort of massive modeling effort. So what we do in this paper is actually we try to be a little bit clever about how to approach this problem. And we want to develop a tractable framework to think about this problem. So how do changes to the balance of macroeconomic risk, and of course we're going to focus on inflation for today, but how do general changes in the balance of macroeconomic risks affect the overall economy, and how should the central bank think about it? So this is more or less broadly what I'm going to attempt to talk about today. So as I said, we're going to place ourselves in a general equilibrium setting. And ideally, what we would work with is a fairly general New Keynesian model. But we're going to assume that some of the inefficient shocks to the model actually can feature time-varying asymmetry. So you can, and I'm going to be clear in a second, but you can think, for example, that the distribution can vary over time, and there can be periods in which, like the draw of a shock can be more likely to be positive rather than negative. Okay, so this is not something that we have not seen so far in this conference. And then we're going to assume that actually agents will receive news about the skew in the distribution of the shocks, which will basically help them build up their perception of risk in the macroeconomy. They will therefore sort of create time-varying beliefs about the state of the risk in the economy, and of course this will affect like their optimization, and will then pass through to basically outcomes, and this will complicate therefore like the choice of the central bank. Okay. So this is more or less like the nonlinear model that we would have in mind that would be probably sort of fit to explain such a question. But then we're gonna sort of try and approach this nonlinear problem with a device that allows us to simplify and rationalize actually what would be going on in such a complicated model. And so what we do is that we provide what we call a representation theorem in the Chorar and Jurado sense, where basically we state that up to a first order, a model with such asymmetric risks can have an equivalent representation, a belief representation. And I'm going to explain it in a second. But the key point is that this belief representation is going to help us in two dimensions. First of all, it's going to help us draw an analytical solution for the optimal monetary policy problem when inflation risk, or more generally when macroeconomic risks are asymmetric. And then it will allow us to basically augment like any type of DSG model that you might have in mind and perform some tractable risk analysis. And you can think about this as policy counterfactual, and this is what I'm going to show later on. But before I move forward, let me just take a moment to sort of pin down, to be clear about what do I mean about asymmetric risks, okay? So in general, when we think of shocks in standard models, we think of them as being symmetric, as being drawn from a symmetric distribution, Gaussian, for example, okay? And we know that if we are interested in linear model or first order solutions, then basically changes to the dispersion of this distribution, to the variance or volatility of this distribution basically have no effect. And this is what is called generally the certainty equivalence. But what we are interested in now is to actually get some asymmetry into this distribution. So this is what we have in mind. We have in mind some distribution which at times can feature more mass on the left or the right of a central tendency. And the key feature here is that the presence of asymmetry drives a wedge between the mean and the mode of the distribution. And this basically something that we are going to exploit in the paper. Why? Well, because there is a very well-known measure in statistics that actually measures this, this wedge, and this is basically the skewness. Okay, this is in its simplest form in the person sense, but of course you have like many measures. But if you look at this, basically you can think of skewness as a measure of the tilt in the balance of risk. Okay, so it's a summary statistics that would tell you whether like risks are more tilted to the upside or to the downside. And then interestingly enough, if you just rearrange this this simple formula, then you get that when you have asymmetry, then the mean is going to be a linear function of a central scenario, which in statistics is called the mode, but you can think of like generally in policy is more referred to a central scenario. And then there is some sort of risk component. Maybe you cannot say it's like the standard deviations times the skew. Okay. And so now you can see that even if you solve the model at first order, even if you're only interested in the expectation as the only sort of moment that matters for your solution, now you need to start thinking about risk as well. And risk intended not only as the dispersion of the distribution, but also of the asymmetry of the distribution. And you can have a case, as we will have, where either one or the other varies, or actually both of them can vary. Okay, so hopefully this is clear, because this is basically what I'm going to refer to for the rest of the presentation. So let me just quickly go through the main contribution of the paper. So first of all, we are going to use this intuition to solve for the optimal monetary policy problem when macroeconomic risks are asymmetric. And I'm going to try and convince you that actually our main result is that there is the optimal policy for the central bank is to lean against the balance of macroeconomic risk and, of course, of inflation risk for this case. But then this is sort of a normative result coming from our model. To sort of give it a little bit more substance, we're going to actually take some data. We're going to take US data for inflation, and we're going to show that there is substantial evidence of time variation in the balance of risk in the post-war period. And we're going to actually show that with a model that we introduce in this paper. You can track this time variation in real time. And then eventually we're going to put everything together, and we're going to say that if you start from this normative sort of prescription that we get for the optimal policy, if you get some sort of data about the time variation in the balance of risk, then you can exploit our approach to put everything into a DSG model, for example, and produce some counterfactual analysis. And we believe that this can be sort of a useful tool for thinking of periods in which the balance of risk shifts like quite abruptly, as it's been the case for the pandemic the last few years. Okay, so I'm gonna just skip the literature during the interest of time, and let me just go to sort of the key point of the paper. So let me zoom in for a second into the New Keynesian setting, and I'm gonna like sort of zoom in on the Phillips curve. So this is the classical Phillips curve, okay, where U is our markup shock. And what we're going to assume actually is that U follows a somewhat general distribution, okay? It's not drawn necessarily from a Gaussian distribution. It might as well be Gaussian, but in principle, we do not take a stand. we are going to make only a couple of assumptions about this distribution. First of all, and this is without any loss of generality, we're going to assume that the central scenario is going to be 0, because this makes us basically consistent with the traditional modeling of having 0 expectations for the symmetric shock, which is equivalent of saying that we want like the mode of a symmetric shock to be 0. And then we're going to assume that this distribution F comes from a two-piece distribution. Now, I'm not going to sort of bother you with what a two-piece distribution is, but the key point of this type of distributions is that it allows us to write the expectation as a nonlinear function between the volatility or the dispersion and the asymmetry. So this is basically able to replicate the formula for the skewness that I've shown you before, which unfortunately is not the case for every skew distribution. And throughout the paper, we're going to assume that rho, which is a measure of asymmetry, rho t, is going to vary over time and possibly be different from 0, therefore. And then lastly, as I mentioned before, we're going to assume that agents receive some noisy signal about the changes in this rho t, so changes in the level of asymmetry in the macroeconomic risk, and therefore form expectations starting from this point. Okay, so this is sort of the nonlinear setting that we would have in mind that we would like to approach. Now, how are we actually approaching it, like to simplify the problem and make it more tractable? Well, we're going to use what we call a belief representation. So we take U, which in our case is our cusp shock with this sort of fancy, possibly skewed distribution. And well, we're going to do something like relatively straightforward. We're going to assume that it can be approximated by a sequence of dummy shocks. Okay, a sequence of J dummy shocks, where J can be sort of an arbitrary number. And we just need to ensure two conditions for sort of this approach to work. First one is that some of this J, actually sort of from little j, from 1 to capital J, they need to be anticipated shock. And so basically, they just need to be able to capture the revisions that agents receive or actually do, like about expectations of future asymmetry. Okay, so as I showed you, like the expectation is going to be sort of this constant here times rho. So if you have revision, then what we can do is that simply we need to take the difference between two revisions of forecasts of rho. We can keep this constant here fixed over time, and this gives us basically our anticipated shock. And if you have J revisions, then you can basically get J dummy shocks. And then the last one, we're going to have one single dummy surprise shock, which happens at little j equal to 0. And this is just to ensure that actually the realization of the shock is not altered. Okay, so you can see that this basically, this phi 0 is undoing at time t the effect of the anticipation. Okay, so all of this is to say that basically up to a first order, a model with time varying risk can be represented with a symmetric Gaussian and zero mean sequence of shocks. Okay, so we have in this case, so if you sort of believe all of this, then what we have done so far is that we have taken a decently nonlinear problem when third order matters, and we have reduced it from the perspective of the first order sort of approach to a linear problem with only Gaussian shocks. And this greatly simplifies the approach, but still gives us like rich enough structure to understand the logic at play and somehow the mechanisms at play here. Okay, so I promised optimal monetary policy, so let's get to the optimal monetary policy. We sort of try to simplify the problem as much as we can. So we start from the textbook three-equation New model, where we have the maximization of the central bank subject to the two constraints, the IS and the New Philip curve. And again, we're going to take no stance on the distribution. We're just going to assume that rho t, so the asymmetry, can vary over time. Okay, and we're going to assume, of course, zero mode, as I said before. So the point here, the crucial point is that when rho is different from 0, then the expectation at time t, so the conditional expectation of the shock, can be different from 0. And this basically buys us one key sort of feature in this model, that when this expectation propagates through the system, then also the optimal expectation about the endogenous variable would be different from 0. And so we're going to get some action by tilting the expectation of the agent. And just to sort of show you how simple this problem can become, I mean, when we set j equal to 1, so we only have one period of revision in the asymmetry, so agents only learn about next period asymmetry and nothing more beyond that. Well, then basically you can approximate the cost push shock in this simple term, in this simple form, where you only have like 3 Gaussian shocks and everything is linear. Okay. So let me show you a little bit what goes on in this small model. So here we assume like the optimal response of the central bank with a period 1 cost push shock or markup shock. Okay. So here in black, you have basically the baseline case with symmetric risk. This is what you would find in, I don't know, like a Gallis textbook or anything else. And everything seems to be like more or less what we should expect. Now, what we're going to do is that, we're going to add basically a 1 period anticipation of a future change in upside risks. Okay, so we are basically telling the agents, look, next period, there is a higher chance of getting a positive markup shock rather than a negative one. Okay, so what is going to happen now? We're going to consider 2 cases. First of all, what happens if agents know about this they learn about this coming upside risk, but the central bank doesn't, or simply doesn't want to believe it. Okay, so what can happen? Basically, you can see that most of the action is at time 0 already, because of course these are anticipated shocks. So you can see that the output gap doesn't really move. So the central bank doesn't do anything in period 0 because it doesn't believe, it doesn't know, it doesn't want to really sort of follow this anticipation. And so it sets the output gap optimally to 0. The interest rate remain fixed, but what happens is that the price level actually increases, like already at time 0 before the shock happens. And this is the mechanism that is at play. Okay, so the anticipation is going to basically make agent worry that next period's costs are going to be higher, and so they basically already act upon it. But what happens when the central bank internalizes this? Well, then it is optimal for the central bank to lean against the balance of risk, of inflation risk in this case. And you can see that, in fact, at period 0 now, the central bank starts depressing demand in anticipation of probable future higher prices. And this basically sort of somehow reassures the agent that the increase in price is going to be somehow tamed, somehow smaller than expected. So you get like a smaller response at time 0. And then basically the propagation continues because we assume only 1 period. But so all in all, hopefully what I convince is that from this optimal problem, it is optimal for the central bank to sort of like lean towards this anticipation of risk and sort of act upon it as soon as they learn about it. Okay, so as I said, I mean, this is sort of a nice normative prediction. So this is done, you can do this, of course, pencil and paper, but then, I mean, the point is that, of course, is this really helpful? Is this actually something that can be used for real policy? So what we're going to do is that we're going to try and estimate the balance of inflation risk in real time. So we're going to use US PC core PC inflation data. I'm going to use quarter on quarter, but results are similar for year on year or any sort of smoother measure that you can that you might want to use. And we're going to use not simple, but like a standard univariate time series model, which are the sort of workhorse for inflation forecasting and modeling. And without going too much into details, this is a model that I've been previously working on with Ivan and another coder of us, Davide, from the Bank of Italy. But you can think of this as an extension of the Stock and Watson model, the UCSV model, that adds on top of stochastic volatility also stochastic skewness. Okay, and then we have some nice econometrics to basically model the time variation in skewness. And I guess this is exactly what I'm talking about. So I can show you later, if you're interested, that the mean and variance that we estimate are basically the same as the one that you would estimate from the Stock and Watson model. But what we get new, what you would not get from their model, is actually a measure of time variation in the skewness of core PC in the US. And you can see that I think two things are interesting from this picture. First one is that skewness moves in a regime-like path. So you can see that it's higher when inflation was higher, and it's actually like negative during the post-Great Financial Crisis, when again like inflation surprised more on the downside rather than not. And then you can see that I think this is mainly interesting for now, like in the last period. So this is up to 2025 Q2. You can see that actually skewness has actually almost halved compared to its peak in mid 2004, but it is still persistently very high. So like there is still a case for being concerned about inflation, at least through the lenses of our model. And the other interesting thing that this model allows us to do, and I'm going to exploit in a second, is actually that it allows us to visualize this decomposition of the expectation into the central scenario, which is the bright blue line here, and what is the balance of risk. Okay, so in a symmetric case, this pink area would always be zero. So like the blue and the black would coincide. But now you see that actually what is the contribution of the balance of risk to sort of the expectation. You can think of this model basically as a way of rationalizing our agents basically form expectations in our model. And you can see that basically the contribution of the balance of risk is positive in the 70s, in the 80s, is positive now during COVID, but it's actually like almost muted during the Great Financial Crisis. And this is due to this nonlinear interaction between volatility and asymmetry, because the post-Great Financial Crisis was a period with very little volatility. And even if you had like significantly negative skewness, where nothing really moves, then there's not much to worry about in terms of like asymmetric risks. So all in all, I think this is something interesting to note, and it can sort of reconciliate also some of the observation about the post-Great Financial Crisis case. Okay, let me just go quickly to the last part because I don't have time. So we have some normative prediction. We have some data that shows us that actually this is relevant. So let's try to put this together for a sort of policy purposes. So we are going to perform some policy counterfactuals. And to do that, we are going to basically augment the Smet and Bowders model with our belief representation for the markup shock. And what we're going to do is that we're going to calibrate these dummy shocks, these phi j that I showed you before, to basically match the revision in the asymmetry coming from our time series model. Okay, if you prefer to use another model, you can still plug them in, and basically you will get everything should work as expected. But the nice thing is that again, everything is linear, everything is Gaussian, so we get back to the usual solution that we like, and then we can work out everything from here. So doing impulse response and everything else becomes like quite simple. Okay, so first sort of policy result. We use the model to sort of simulate what would happen if agents basically revise their expectations, okay? So we consider two cases. In black, you have the one-off build-up, one-off sort of revision. So in period one, agents learn about a change in the asymmetry. So it's going to be positive asymmetry tomorrow. Then this decays over time, where we assume linearly. But then you can see that inflation, interest rate, and hours worked, which are like the key observable in the Smet and Bowders model, they already move like quite substantially. And this is sort of making the case that these revisions actually are economically relevant. And even more so, if you sort of give these revisions not only like sort of more strength, so almost double them, but also like more persistence, you can see that this the effect amplifies quite nonlinearly. And last, we're going to just think about how should policy think about this, okay? So how can policy sort of think about this asymmetry? And then what we do is that we take the Taylor rule, we augment it with some forward guidance shocks. And again, these forward guidance shocks are basically meant to are calibrated to match the revision in the asymmetry. And this is basically a device where the central bank can communicate sort of temporary deviation from the 2% inflation target, for example, in order to sort of rebalance the expectation that would be otherwise sort of skewed by asymmetry. And this is what we get for the US. We have similar results for the Euro area. But here in this first panel, in this top left panel for you, is the revision to the balance of risk as we estimate. And you can see, of course, that this becomes like quite massive during the COVID period. But interestingly, what you see is that revision starts to pick up like already in the middle of 2021. So like already in the middle of 2021, the model perceived that risks were building up. And then here in this 3 panel, very quickly, you can see basically our counterfactual rate, if the central bank followed what I showed you a second ago, compared to in green, compared to the black line, which actually were the realized data. And 2 comments, and I conclude. You can see that in terms of interest rate, the liftoff happens like somehow like 6 quarters before, but it happens with similar magnitudes and terminal point as the real data. So this is to say that our model will just predict, like the anticipation that I tried to tell about before. This brings inflation down a little bit quicker, but interestingly, it does not have like a substantial cost, actually has almost no cost in terms of real economy, like if you consider like the end of the period, because you can see that the green and the black light are almost at the same level. Okay, so I guess I'm running out of time. So, I mean, we just want to understand how asymmetric risk can be thought about in a general equilibrium setting, and we try to simplify our approach to this problem. And this is useful to get some policy counterfactual. And yeah, thank you very much.
Right, our discussant will be Matthias Rottner from the BIS.
Yeah, so first of all, thank you very much to the organizers for letting to discuss me this paper. And these are just my views and not the one of the BS or the Bundesbank. And so let me really start. So I think it's a really great paper, and it really helps us to think and account for asymmetric risk in a like very tractable and useful way. And then I think like based on this, that we can now incorporate them in a very nice way. Then we can look at what are the implications for conducting monetary policy, and in particular with like looking into like risk management considerations. I think it's really a nice paper, and I enjoyed to read it a lot. And let me also, I think Andrea already did like a great job in summarizing this paper. So nevertheless, I have prepared some slides, so I will give you a bit my take on that paper. So really like what is the main question here is like what are the implications of evolving asymmetric risk, and in particular look at monetary policy for this. And to address this question, what they develop a new approach so that they can incorporate this asymmetric risk into like standard macro models. I mean, as you said, Smets and Wouters, but I mean, you can put it in basically in almost any macro model. And it's a very tractable approach, and really like the focus in their approach is on the difference between the mode and the mean in the exogenous risk. And then what they find is that this inflation risk is time varying over time and typically asymmetric. And then from the policy side, monetary policy should lean against this asymmetric risk or this balance of inflation risk. And so what is the main concept of the paper? And so let's start going back to like a exogenous markup shock here. So we talk here about exogenous risk. And so the usual case, if we have like a model, we draw this shock from a normal distribution. And what you can also see at this normal distribution, the mean and the mode, I mean, at the standard normal, they are at the same point. But then one thing is, okay, so now this is maybe for normal times a good characterization, but maybe we care about like tail risk. So what do we think about like basically increasing the standard deviation of our normal distribution, thinking of an uncertainty shock? So we could make this normal distribution a little bit more wide, so we have more weight in the tails, as you can here see from the green line, but at the end, you still have the mean and the mode at the same point. And this is basically where their paper comes in, is that they now work, I mean, as Andrea already said, with a 2-piece normal distribution. So they want to basically have like, they draw from from an asymmetric distribution. And I mean, I now just use as an example, this 2-piece normal. So you can see for the left-hand side, basically the purple line describes this 2-piece normal. And what you can see, the left-hand side, there is much less in the power, weight in the tails, compared to the right-hand side of this 2-piece normal. And this is how they generate, by this distribution, how they generate like this difference between the mode and the mean. And then, I mean, you don't need to use like a 2-piece normal, but you can also use some Skew T distribution. So this is kind of like the idea what they have. And then the last part is that they want to make things tractable. And to make this tractable, basically, they boil it down to looking to looking at what's the difference between the mean and the mode. So they don't look at other parts of that distribution anymore, but just how is the fluctuation from this two-piece distribution between the mean and the mode. And here the focus is like basically like they look how expectations are changing under this distribution, so that you have this expected changes in this asymmetry, and how this then spills over to the economy, and also how they revise expectations if there is like a difference in between the mean and the mode. And then, but you know, I mean, to make it tractable, I mean, what already was presented is that they use that basically you can make this belief. You can show that this is like a first order equivalent for like if you work with a belief representation. So basically we can go back to like standard techniques, and it's just adding anticipated shocks to the model, thinking about like Cristiano Motto and Estanio, the paper, for instance. And the nice thing is once you use this mapping, you can go back to your standard solution method. So I think that's why it's a very nice and tractable way of incorporating asymmetric risk. And then you can like do like policy analysis based on this. Okay, so this was my summary of the paper, and now let me also give a few comments on it. So I think that they also start like, and was presented here was the optimal policy problem for a small scale model, and that they show that this asymmetric risk has a role because it changes expectations. And then later on in the paper, when they go to the Smets-Wouters model, they suggest like a policy rule that is adjusted for the risk management consideration. And I think here just would potentially nice to map these two parts a little bit more. So I mean, you show that the risk-adjusted policy rule like has good, you know, has like good properties. But I mean, how close would this be to constrained optimal policy simulations? Just I think really like because you start with optimal monetary policy, would be maybe nice to see how much your risk-adjusted Taylor rule really like represents optimal monetary policy. And then the other one is, I think, is a bit more like a philosophical question, because, I mean, what the paper is about, I mean, in the end, they look at the difference between the mean and the mode. But it really starts between what is asymmetric risk versus the role of anticipated shocks. And I mean, when you look only at the mean and mode, this is the same. But what I plotted here is like the two-piece normal distribution versus a normal distribution where the mean is shifted. And so they are like slightly different. But I think the question that you can ask yourself is, what do you think is like a better representation of reality when we think about this evolving of exogenous risk? Do we think that the entire normal distribution shifts, or maybe we actually think more about the like a more skewed with a larger weight in the tails? So I think this is just, for me, you know, I mean, I think this is just because they show that it's first order equivalent, but I still think it's important to think about what is a better representation of reality. I don't have an answer, but I think it is important. And then another comment about this equivalence. So I think they show that this is for first order. And this also, in my opinion, having worked a lot with nonlinear models, this should also hold for a global solution method as long as the model is fairly linear. And I'm pretty sure personally that this covers a canonical nonlinear nucleation model. So if I take like a very standard, small, with not too much standard deviation nonlinear model, this also would hold globally. But the thing is, of course, this is like, but what happens actually if the model would be highly nonlinear, if I have a zero lower bound, I have endogenous financial crisis, or like a nonlinear Phillips curve. And then, of course, this mapping does not hold anymore globally. And I think this brings me to, I think, the most important point for me about this paper. And this is this distinction between exogenous versus endogenous risk. And the question here is, why is the balance of risk moving? And so what the author suggests is, it is because the shock distribution is changing exogenously. I think another rationalization of this whole thing could be that the underlying structural forces are moving. And so I think this distinction is important to understand the dynamics, you know, what is going on and the policy implications. So if we think about the risk of the zero lower bound, price setting behavior, supply chains. So is it like that we just have a movement in this exogenous risk or really underlying structural forces? Because it will have an impact on optimal monetary policy, or generally on monetary policy. So think about the risk of the zero lower bound, even though maybe not the most interesting right now. But I mean, if we think about the risk of the zero lower bound, if I have, let's say I can make a policy that I will will not hit the zero lower bound anymore, basically the risk of my zero lower bound will disappear. Because with my policy and then this underlying structural force, I can basically remove. But in the contrast to this, if I have the exogenous risk, I can do the same policy. I could implement this, but the exogenous risk would still stay there. So in that sense, like you would have not exactly, like if you believe that it's fully exogenous risk, then this is okay. But I think if it's endogenous risk, then there will be some part that you will miss. And then your for instance, your optimal monetary policy would basically differ for exogenous and endogenous risk. And like here, like just a picture of my work where we had some asymmetric monetary policy rule, but then you would have actually like a different calibration of such a rule. And this brings me to my last point. So I think, well, I really appreciate the tractable approach. I think one nice thing is that, I think like working myself with nonlinear models, it's very, very hard to develop them, especially quickly. So I think this one is a great approach, but I think we should still complement them with structural models. And we should think about these also at the same time. But how can we solve such large and complex models? And let me here take the chance to advertise my own work. So, I mean, because if we really want to think about these nonlinearities, I mean, in a Smets-Wouters models and stuff, what we need is like solution methods that can bring us to that. So in my work, what we have done, we have kind of like used the advances in AI and using neural networks to like estimate like nonlinear rank models, nonlinear rank models, and so on. So I think it's really like, I think my opinion, you need both. You need like a tractable approach that gives you very good insights very quickly, and then you maybe combine them with a more structural approach. And also other solution methods we are currently developing, like generative economic modeling, and really like here the idea that we want to bring this closer, that we get more used to work with nonlinear models. Okay, let me sum up. So I think it's a really great paper, very, very useful to evaluate inflation risks. And then I think also like from a policy side, I think distractibility is a great plus. It makes it very useful for policy analysis. Still, I think, we should complement this by more structural models that not only assume exogenous risk, but also endogenous risk. And I think the last thing about this paper is I think also it gives some guidance on monetary policy and also the role of risk management. I think also when we think about scenario analysis, maybe like a very helpful insight from that paper. And yeah, thank you very much.
Thank you, Matthias. All right, time for questions. Yes, please.
Thank you. Just a clarification. So when you look at second moment shocks, then the first moment is kept constant. So, but here you're changing the skewness. When you change the skewness, you change the first moment. So when you show those responses to the skewness, are you showing something that is over and above the change in the first moment, or are you conflating that? How should I think about that? Thanks.
Other questions? Yes, please.
So thanks a lot. I really like the paper. So something related to the discussion, I think he has a good point. What is a shift in the normal distribution? So as a motivation of the paper, you could look at surveys because there, I mean, you often see that the expectations are asymmetric. So it's just a suggestion.
Can I also ask something?
Please.
So you start with this linear model where you know that you have certainty equivalence, so skewness doesn't matter. And then you allow this U shock to have conditional mean that's not equal to 0. And then you try to explain that with anticipated shocks. Now, this has two implications. First, I think in terms of the rational expectations, you no longer have that the right-hand side, that the conditional expectation of the left-hand side is the right-hand side of the equation. So that, of course, is not rational expectations. Maybe that's what you want. Maybe that's what you're doing. But more in terms of taking the model to the data, when you have equation like this that doesn't have a centered error, and you take that to the data, basically, if you write a likelihood, the score vector will no longer be a martingale difference. And so you get inconsistent estimation. So I'm totally sympathetic with the fact that you want to look at third moment and how the third moment affects behavior in these models. But I think the proper way to do that is to start with a nonlinear model and maybe do a higher order, a higher resolution, and then really have the third moment entering in the solution of the model. I know it's difficult, but I'm concerned about the estimation in this model.
Why don't we pause there and take it away?
Okay, so thank you very much for the question, and thank you, Matthias, for the great discussion. So okay, I'm gonna be quick. So especially on the your first point about sort of linking the policy exercise to the optimal monetary policy. No, I guess that's a good point in a sense. We could have done sort of a Ramsey exercise with the Smet and Bowders or any other model, of course. So this is a well taken point. I think what we wanted to do in the last part was mainly sort of to also like make this prescription a little bit more practical and show how this could be used in practical sense for like central banks and policy counterfactuals. But that doesn't, of course, like it's a complement to what you were saying, of course. And to the second point, and also what Paolo commented, yes, we in an earlier version of the paper, actually, we did justify this approach with looking at SPF distributions, which are in fact asymmetric. It is, to the best of my knowledge, non-trivial to sort of collect nicely sort of shaped distribution for the bins of SPF, and this has been like a little bit of a challenge, and this is why we removed it in the end. But this is something that we looked at, we are looking at, and that's definitely the way to go to sorry, to motivate this point. So yeah, thank you both. And the last part of your discussion, I mean, about the zero lower bound. Well, I guess you all know that probably it's been the second thought of Leonardo after we started this project. So that is definitely something that we don't do now, and we cannot accommodate in a straightforward way as of now. So in a sense, that is good to have for another project, but in in the current setting, of course, like we can only have like exogenous risk coming into play. So but that's absolutely a well taken point, and as well the one about complementing it with a nonlinear model. Also, Caterina was saying, I think absolutely this makes sense. One thing that we generally get from the literature is that when you use, I mean, I'm not the expert here, of course, but when you get to this sort of nonlinear model solved with higher order sort of perturbation moments methods, you generally get that the effect of these higher order terms is somehow smaller than you would expect. And I guess that in our settings, perhaps the fact that we only focus on the first model makes this mechanism not necessarily like stronger, but a little bit just more apparent. So I think, yeah, there's merit to sort of look at both sides. About the other question for the IRFs. So no, what I showed you are basically the effects of the revisions in the asymmetry after the effect of the mean has been removed already. So you can think of them as sort of news about the pure asymmetry of the shock. Okay. So and about the last point, so about the rational expectation. So of course, in the nonlinear model, well, I think we still sort of think that agents are rational because, well, they know about the distribution and the changes in the distribution. I understand your point about the non-centered shock, but I guess this is why also then we rely on this other approach. On the second point, I think actually that is not the case. In our model, in our time series model, when we estimate the skewness, we do write the likelihood function. I mean, we don't estimate it in maximum likelihood, but we do have a likelihood function for it. And actually the score vector, it is a martingale sequence. And actually we have sort of proof for actually the score vector.
If you write down a model where just a single equation model, where the left-hand side, the right-hand side is not the conditional expectation of the left-hand side, so that your error or your U doesn't have a conditional expectation 0, this will automatically imply that the score vector is not a martingale difference, and you will get inconsistent estimators. Now, you may be able to add an intercept, and that will soak that non-zero mean error, but otherwise, we can write it down.
Yeah. So if you're talking about the time series model, then I can show you that that is the case. If we are talking about sort of the because you mentioned U, if you're talking about the nonlinear model with sort of this generic distribution in the New Keynesian Phillips curve, then again, that perhaps that is going to be the case, but this is exactly why we are sort of working around it. So I take sort of the stylistic point about the econometrics, but I think that that is also sort of adding to the value of what we are doing, in a sense that you get a very complex problem, perhaps ill-defined in terms of econometrics, but then with our method, then you go back to a shock vector that actually is mean 0 and linear. So yeah, thank you very much. Thank you.
Right, we might have time for one more question if there is one. I'll just throw out one last one. So you are very careful on the inflation side, which we appreciate here for the inflation conference on behalf of the organizers. Of course, the way you model that has implications for output and by extension unemployment, and that has a dual mandate. So how should we think about that?
Yeah, thank you for this question. So of course, that is something that we did discuss in developing the paper. You could, in principle, like add another inefficient shock that can give you some asymmetries on the sort of demand side. We did not go for it at the moment because, of course, like the model is already quite rich and the mechanism is already sort of non-clear. But in principle, that is something we could do. And in this case, like you would need to have an interplay between the skewnesses, in a sense, of the demand and the supply side, which I think the interesting thing that can happen is that at times they can offset each other. And so sort of what seems now a complicated trade-off for the central bank and sort of somehow simplify in a sort of divine coincidence for higher order moment type of event. But that is definitely something that we're thinking about.
Thank you. Another round of applause for our first paper.